You've seen the ads, right? The gurus online, flashing cash, telling you that with just $100, you can tap into the biggest financial market in the world. But is that for real? Can you actually turn a small stake like that into a fortune? Well, in this explainer, we're going to dig into the actual data and find out the truth. Let's get right into it.
I mean, the idea is just so tempting, isn't it? Taking a single $100 bill, something you might spend on a nice dinner, and spinning it into a real nest egg. It's the ultimate financial underdog story. And in the Forex world, there's one special tool that makes this whole dream seem possible.
And that tool is leverage. You can think of it like a financial superpower. Basically, it's a loan from your broker that lets you control a way bigger position than you could with just your own money. So that $100 of yours, with high leverage, suddenly it's trading like it's $5,000, maybe even $10,000. The potential for profit just gets massively amplified. But, and this is a huge but, so does the risk. And that's where the dream can very quickly become a nightmare.
Okay, so high leverage sounds like the golden ticket to huge profits. But what happens when we ignore the hype and just look at the cold, hard data? What does the evidence really say happens to the average person who dives headfirst into high leverage trading?
Yeah, we're not going to rely on stories from some anonymous forum or testimonials from so-called experts. Nope, we're going straight to the source, a huge study from the National Bureau of Economic Research. These guys got their hands on the actual trading records of thousands of regular traders just like you to find out what was really going on. And what they found is, well, it's staggering. Before some new rules were put in place, the average trader using high leverage lost, get ready for this, a whopping 44% of their account. And that's not per year, that was every single month. Just let that sink in for a second.
And this chart right here just drives that point home. It's so clear. Look at that bar on the left. That's the massive loss for high leverage traders, that 44% monthly drop we just talked about. Now look over at the bar on the right. Those are the traders who use low leverage. Now they still lost money on average, but it was a much smaller 3% a month. The difference is just night and day, and it all comes down to leverage.
So with numbers like that, it was pretty obvious something was seriously wrong. We're not talking about a few unlucky traders here. This was a widespread problem. Thousands of people were losing their savings at a truly alarming rate. And that's when the US government decided it was time to step in. So back in 2010, the Commodity Futures Trading Commission, you'll hear them called the CFTC, they stepped into the picture. They saw the incredible damage that all this high leverage was causing, and they brought in new rules specifically designed to protect everyday traders from completely blowing up their accounts. So what did this new rule actually do? Well, you can think of it like they put a speed limit on leverage. Before 2010, it was kind of the Wild West. Brokers could offer absolutely insane leverage, sometimes over 100 to 1. The new rule slammed the brakes on that, bringing it down to a much more reasonable 50 to 1 for major currencies. It didn't get rid of leverage, but it did force traders to take their foot off the gas. Now, this created a perfect natural experiment for the researchers. They could now compare how traders did before the rule with how they did after it was put in place. It was a real-world test to see if this leverage speed limit actually worked. So, what did they find?
The results were pretty dramatic. First off, with less leverage available, the total amount of trading dropped by about 23%. You'd kind of expect that. But here's the amazing part. For those traders who were getting absolutely crushed before, their losses were cut by an incredible 40%. The speed limit was working. It was literally saving people from financial ruin.
Now, of course, this regulation wasn't without some consequences. With less crazy trading going on, the brokerage firms that make money off of all that activity, well, they took a hit. Their operating capital actually dropped by about 25%. So, while the traders were a lot better off, the industry definitely felt the pinch.
And this gets to a classic debate anytime you talk about financial rules. Did this speed limit accidentally hurt the market overall? You hear people talk about liquidity, which is just a fancy way of saying how easy it is to buy or sell something. So by cutting down on trading, did they make it harder for everyone to trade efficiently? Did they create a big financial traffic jam?
Well, the researchers had a very clear answer to that question. I'm just going to read a line directly from their paper. It sounds a little academic, but the message is crystal clear. It says the policy, quote, improves belief-neutral social welfare without reducing market liquidity. What does that mean in plain English? It means the rule protected traders without gumming up the works of the market. The financial highway became safer for everybody, and it didn't even cause a traffic.
Okay, so let's bring this all back to where we started. With all this data on the table, what is the final verdict on our big question? So, is $100 enough to start trading Forex?
The simple, technical answer is yes, you can open an account with that much. But the much, much more important question is, should you? The data from this study couldn't be clearer. For most people, using high leverage with a small account is just a recipe for disaster. Those government rules that capped leverage weren't about killing the market. They were about protecting regular people from losing their shirts.
You know, this whole thing really boils down to a fundamental question. When you're using high leverage with a small amount of cash, are you truly investing for the long haul, or are you really just gambling on short-term price moves? The data suggests the odds are heavily stacked against you. So before you dive in, that's a question you really need to ask yourself.
Hey, if you found this data-driven breakdown helpful, we'd really appreciate it if you'd hit the like button, share it with a friend, and subscribe to our YouTube channel, How to Start Forex, for more deep dives just like this one. Thanks so much for watching.
So how much money do you really need to start trading Forex? It's probably the #1 question every new trader asks. And if you go looking for an answer online, wow, it's a total minefield. In this explainer, we're going to cut right through all that noise and get to a real, practical answer.
And this right here, a post from a Reddit user, this is what starts the whole debate. It just perfectly captures that confusion, right? On one hand, you see these amazing stories, $100 turning into hundreds more, but then you hear all the warnings, people saying that starting with so little is just throwing your money away. So what's the deal?
To figure it out, we've got to step right onto that online battleground where these arguments happen 24/7. And believe me, the answers you find are, well, they're a wild mix of incredible hype, some pretty brutal honesty, and every now and then some seriously hard-won wisdom.
And let's be honest, this is the dream. This is the kind of post that grabs your attention and doesn't let go. The idea that you can take just a little bit of cash, $100, and 5x it in a weekend, that's the siren song that pulls so many of us into trading in the first place. It feels so possible.
But, you know, for every one of those amazing stories, you get this. The more common reality, usually shared with a bit of a laugh. This is the experience most new traders actually have. Not some crazy explosion, but a slow, kind of painful grind downwards. It's funny for sure, but it's also a huge warning sign.
Now, this one is really interesting because it's both stories rolled into one. You see the incredible high, turning $100 into $1,000. I mean, come on. But then you see the crushing low of losing it all in a single trade. This right here gives us a huge clue. Those quick, easy wins can make you feel invincible, and that's when you're in the most danger.
So what's actually going on here? What's the hidden engine behind these incredible account flips and these catastrophic blowups? How is it even possible to win or lose so much money so incredibly fast? Well, it all comes down to one powerful and really dangerous tool, a true double-edged sword for any trader.
And that tool is called leverage. In simple terms, your broker is letting you use borrowed money to control a position that's way bigger than your actual account balance. It's what makes Forex so attractive, but it's also what makes it so risky. Think about it. With high leverage, a tiny price move in your favor, like 1%, could literally double your money. But a 1% move against you could wipe you out completely. That's the double-edged sword in action.
And this brings every new trader to a fork in the road. You have to make a choice. Are you on the gambler's path, using huge leverage, chasing that lottery ticket win? Or are you on the strategist path, focusing on building a repeatable process and managing your risk? How you answer that question, it changes absolutely everything.
So let's just leave the gambler's path behind for a second and look at how the pros, the strategists, think about this whole problem. You'll see their secret has almost nothing to do with how much money they start with. It's all about how they decide how big each trade should be. Our guide here is a guy named Tom Basso. He's a legendary trader featured in the famous New Market Wizards book. And get this, his nickname was Mr. Serenity. Why? Because his whole approach to trading was just so calm and process-driven. It's a complete world away from that emotional roller coaster of trying to flip small accounts. And Basso shares this absolutely game-changing rule from another legendary trader, Larry Hite. It goes, never risk more than 1% of the total equity on any trade. This idea completely flips the original question on its head. See, the pros aren't asking how much money can I make? They're asking how much can I afford to lose if I'm wrong? That mindset shift, that is the key to survival.
This is the magic number, 1%. Just let that sink in. This single concept is the absolute foundation of professional risk management. It's what turns trading from a pure gamble into a calculated business, one where you can actually survive a losing streak and live to trade another day.
So how do you actually put that into practice? Well, Basso breaks it down into 4 really simple steps. First, you know your total equity, how much money you have. Second, you set your risk per trade. Let's stick with that 1%. Third, and this is so important, you figure out where your stop loss needs to go based on the actual chart, not based on what you want to lose. And then, and only then, as the very last step, do you calculate a position size that guarantees if you get stopped out, you only lose that 1% you plan for.
Now that we've seen this calm, methodical approach from the pros, it suddenly becomes painfully obvious why the huge majority of new traders fail. They're not even playing the same sport.
I mean, just look at this list of top reasons traders fail. Poor risk management, unrealistic expectations, letting emotions take control, no discipline. Does any of that sound familiar? It's the exact opposite of the calm, calculated 1% rule we just talked about. It's the gambler's path, plain and simple.
The one thing that connects all of those reasons for failure, it's a desperate focus on the outcome, on the profit, instead of a disciplined focus on the process. Chasing the money is what gets you into trouble. Executing a solid plan is what gives you a real fighting chance.
Okay, so with all of this new info, let's circle all the way back to the beginning and finally answer that original question, but this time from a much, much smarter perspective.
So, can you start with $100? Yes, 100% yes. But, and this is the most important part, you have to stop thinking of that $100 as your lottery ticket. Instead, you need to think of it as your tuition. It's the price you pay to learn the process of trading correctly, to practice your discipline, and to feel what it's really like to have money on the line without risking anything that's actually going to hurt you.
So what's the best way to spend that tuition money? Well, the Reddit forums actually had some amazing advice. Start with a demo account, but use a realistic balance, like a couple $100, not 100,000. Or open a live micro account where you can risk just cents per trade. You could even try a prop firm challenge, where their super strict risk rules literally force you to develop good habits.
And this comment from another Reddit user really brings us full circle. It just goes to show you that hidden among all the hype and the crazy stories, there are people who have learned this lesson, probably the hard way. It's not about the money. It has never been about the money. It's about the process.
So that's the real question you have to ask yourself. Forget about whether you should start with $100 or $1,000. The only thing that truly matters is this. Are you focused on the unpredictable outcome, the profit, or are you focused on the one thing you can actually control, your process?
Hey, if this new way of looking at trading was helpful for you, we'd really appreciate it if you'd like this, share it with a friend, and subscribe to the How to Start Forex channel for more explainers just like this one. Thanks for watching.
All right, let's just jump right into it. How do you turn $100 into 1,000? I know. It sounds like a get-rich-quick scheme, doesn't it? But what if I told you there's a real, honest-to-goodness business model behind that question? Well, today we are breaking down the exact blueprint for how it's done. So here's the big question on everyone's mind. Can you actually do this? Is it really possible to go out, find everyday products, and then multiply your money by selling them online? Well, the answer is a huge resounding yes. And there's a very specific strategy to make it all happen. You know, the secret to making this work isn't some complicated financial trick. Nope. It's actually a pretty simple strategy that's all about finding price differences in the market. It's a concept called retail arbitrage. So what in the world is retail arbitrage? Well, to put it simply, it's the business of walking into a local store, finding an item that's selling for a low price, and then turning around and reselling it for a higher price on a massive online marketplace. You're basically taking advantage of a price gap that most people don't even realize is there. And this quote just makes the whole idea crystal clear. Think about it. A $10 item you see every day on a shelf at your local store could be worth 4 times that much online. And we're not talking about a rare fluke. This kind of price difference exists for thousands and thousands of products right now. Okay, but where do you actually sell these things to get that higher price? Because let me tell you, not all online marketplaces are created equal. The platform you choose to sell on is maybe one of the most important decisions in this whole business model. And this chart just illustrates the difference perfectly. You've got eBay, which feels kind of like a digital garage sale, right? Buyers have to dig through dozens of different listings for the exact same item. But then you have Amazon, where every single seller lists their item on one unified, clean products page. This creates this trusted, premium feel, and in that environment, buyers are just willing to pay more. But the real game changer, the secret weapon, is a program called Fulfillment by Amazon, or FBA. This thing lets you operate like a giant corporation, but without any of the headache. You just find the products and ship them in one big box to an Amazon warehouse. That's it. From there, Amazon handles everything: the storage, the packing, shipping it out to the customer, even customer service and returns. And the best part? Your items instantly get that Prime badge, which, as you know, is a massive driver for sales.
Okay, so you know the what and you know the where. But how in the world do you find these profitable products without spending your entire life walking up and down store aisles? Well, you need the right tools for the job.
Just imagine doing this the old way. You'd be in a store, furiously scribbling down barcode numbers on a notepad. Then you'd have to rush home, look them all up on your computer, only to find out, they're not profitable. Or even worse, they are profitable, and now you have to race back to the store and just pray they're still on the shelf. It was just incredibly slow and inefficient. But thankfully, technology is the solution. Apps like this one literally put all of Amazon's data right into the palm of your hand while you're standing in the store. The author described it perfectly. It's like putting on special glasses that let you see the profit potential floating over every single item on the shelf. You just scan a barcode and boom, you instantly know the Amazon price, how well it's selling, and exactly what your potential profit is. It's a game changer. Now, all of that sounds great in theory, but does it actually translate into real money? Let's look at the proof, shall we? The authors shared actual screenshots of their Amazon payouts, and trust me, the numbers are absolutely eye-opening. So here we have a payout from late November. This is right at the beginning of the holiday shopping rush, what sellers call Q4. And look at that. That's over $18,000 in just 2 weeks. But believe it or not, that's just the warm-up. You fast forward just 2 more weeks, and as Christmas gets even closer, that payout nearly doubles to over $30,000. This is the raw power of tapping into that seasonal demand on the world's biggest retail platform. It's just insane. And just to prove this wasn't some one-time fluke, here's a payout from the very next year's holiday season, still pulling in over $27,000. This just goes to show you the repeatable, incredible power of that Q4 holiday rush. You know, this isn't just for some tech-savvy superseller. The author shares this incredible story about his own mom, who they called the FVA grandma. She learned this exact business model, went out scanning products consistently, and built an income that allowed her to retire early and travel the world. I mean, come on, if she can do it, the barrier to entry is probably a lot lower than you think. So now you've seen the business model, you've seen the tools, and you have seen the proof. The question really shifts from how does this work to, how could this work for me? I love this baseball analogy because it's one of the most important takeaways. It's so easy to get obsessed with finding that one home run product that's going to make you rich overnight. But the real sustainable success in this business comes from just hitting singles, consistently finding those products that make you $5, $10, maybe $20 in profit. Those small wins add up so much faster than you can imagine. But with that being said, those home runs, they definitely do exist. This seller, for example, was at a Blockbuster Video when it was going out of business and found items that were selling for 25 times their clearance price on Amazon. I mean, that's literally like turning a $1 bill into 25. Incredible. And that really leads us to the final thought I want to leave you with. The next time you walk into any store, Target, Walmart, wherever, I want you to look at the shelves a little differently. What hidden profits are just sitting there, hiding in plain sight, waiting for someone with the right glasses to come along and find them? Hey, if this explainer gave you a totally new way to look at retail, do me a favor and hit that like button, share it with a friend, and make sure you subscribe to the How to Start Forex channel for more breakdowns just like this one. Thanks so much for watching. So, you've seen them, right? Those ads all over the internet? The ones with some guy on a yacht promising you can make a fortune just by clicking buttons on your laptop, trading currencies? Well, today we're going to pull back that curtain and ask the really tough question. Is trading Forex actually a good idea? Because that's really what it boils down to. On one side, you've got this incredible dream of financial freedom. But on the other, there's this brutal reality of a market that can and will chew you up and spit you out if you're not careful. It is a super high-stakes world, and we're about to dive into both the glittering promise and the pretty grim truth. All right, let's get into it. We're talking about the foreign exchange market, the biggest, most liquid financial playground on the entire planet. But here's the thing. For every story you hear about someone making a quick profit, there are thousands of stories of quick, really painful losses. And we're going to find out why. So first up, let's talk about the dream. What is it about Forex that pulls so many people in? What's the big allure? Yeah, this really breaks it down. See, unlike the stock market, you don't need a ton of money to get started. The barrier to entry is super low. And the market's open 24 hours a day, 5 days a week. You can trade from your couch in your pajamas in the middle of the night. It's the ultimate promise of freedom, right? But, and this is a big but, that is only half the story. And here's where we slam on the brakes and pivot from that dream to the cold, hard data. Honestly, if you were even thinking about trading Forex, you have to see these numbers. Brace yourself. You know, sometimes the internet just tells it like it is. This comment from a user on Reddit puts it so bluntly. For most people, it's a financially costly waste of time. So, just how bad are the odds really? Let's look at the actual numbers. Now check this out. This isn't some number I just made up. This comes directly from a major broker's own disclaimer, the one they're legally required to show you. Almost 75%, 3 out of every 4 of their clients lose money. That's the risk, straight from the horse's mouth. And it's not a one-off thing. The popular trading education site Baby Pips, a place where people go to learn, reports a very similar, very sobering number. About 80% of retail traders are unprofitable. You're starting to see a pattern here, right? And it's not a pretty one. But you might be thinking, okay, but what about the people who stick with it, the dedicated ones? Surely they get better, right? Well, an academic study of day traders in Brazil found something truly devastating. Of the traders who kept at it for over 300 days, a staggering 97% of them still lost money. Why? Because it's like death by 1,000 cuts. The commissions, the spreads, the constant psychological pressure, it just grinds you down. So when you hear that old saying that 95% of traders fail, well, this is what it looks like. This is the reality. The odds are just overwhelmingly stacked against the little guy. It's not technically impossible to succeed, but you gotta understand, you're playing with lottery-like odds. And as if those statistics weren't bad enough, there's a whole other layer of danger we have to talk about: scams. The Forex world is unfortunately full of predators just waiting to take advantage of hopeful newcomers. So let's talk about how to protect yourself. The scams usually come in a few different flavors. You've got your fake brokers who build these really slick, professional-looking websites just to get you to deposit your money, which you'll never see again. Then you've got signal sellers, people charging you a monthly fee for guaranteed winning tips that are often just random guesses. And of course, the classics, Ponzi and pyramid schemes, all dressed up in Forex lingo. So how do you spot them? You've got to keep your eyes peeled for these giant red flags. First off, anyone who guarantees profit is lying. Period. There are no guarantees in trading. Watch out for high-pressure sales tactics. You have to deposit money right now. A huge one is an unregulated broker. Always check their credentials. If you ask simple questions and they give you vague, evasive answers, just run. And finally, if you see a sea of perfect 5-star reviews that all sound the same, yeah, they're probably fake. And what if you think you've already been scammed? Okay, don't panic, but you have to act fast. First, stop. Everything. Don't deposit another cent. Try to withdraw whatever money is left. Then, report the company to the financial authorities. And finally, please, share your experience online to warn others and stop them from falling into the same trap. So, let's say you've dodged the scams, you've stared those brutal odds in the face, and you're still determined. Okay, but you have to understand, this isn't a game. It's not something you just casually try. It's a profession, and it requires a whole new set of skills and knowledge. You basically have to learn a whole new language. Take a simple word like PIP. It stands for percentage and point, and it's the tiniest price move a currency pair can make. It's how you measure your profit or loss. For example, if the euro to dollar rate moves from 1.1050 to 1.1051, that's just 1 pip. It sounds tiny, right? But with leverage, those tiny little pips can add up to huge money, or devastating losses. And that brings us to leverage. Think of leverage like a superpower your broker lends you. It lets you control a huge position in the market with only a tiny bit of your own money. It's the magic ingredient, the secret sauce that makes those massive profits you see in the ads seem possible. But it's also the very thing that makes Forex so incredibly dangerous. And this right here, this is the most critical thing to get. Leverage is a massive double-edged sword. Yes, it can magnify your winning trades into huge profits. But, and you knew this was coming, it magnifies your losses just as fast, if not faster. A small market move against you can trigger a margin call and completely wipe out your entire account. I'm talking gone in seconds. So to even have a fighting chance, you can't just be good at one thing. You need to become an expert in all these different fields. You have to be a chart wizard, an economist tracking global news, a psychologist who can master their own fear and greed, and a ruthless risk manager all at once. And this is why those failure stats are so high. Most people are lucky if they can master one of these. Almost nobody masters all four. And you have to remember who you're playing against. It's not just other regular folks like you. You are literally competing against giant Wall Street firms with armies of PhDs, supercomputers, and advanced AI models running complex algorithms. It's kind of like your local high school basketball team trying to go up against the pros. The odds are not in your favor. You've heard this quote a million times, I'm sure, but in trading, it is everything. If you don't have a detailed, well-researched, and rigidly followed trading plan, you're not trading. You are simply gambling. And as we've already seen, in this casino, the house almost always wins. Okay, we've been through a lot. We've seen the dream, the brutal statistics, the scams, and the absolutely insane learning curve. So let's circle all the way back to our original question. Is trading Forex right for you? Look, the honest answer for the vast majority of people is probably not. But it might be for a very, very specific type of person. We're talking about someone who can truly stomach huge risks, someone who has put in the years of education to build a rock-solid plan, someone with the emotional discipline of a Zen master, and this is the most important one, someone who is only trading with capital they can 100% afford to lose, like literally set on fire and be okay with it. We'll leave you with this final piece of advice, and it's a powerful one. Success in this game isn't about being a lone genius who outsmarts the world. It's about being humble. It's about listening to what the market is telling you and having the incredible discipline to follow your plan, no matter what. For most people, that's a very, very costly lesson to learn. Now, if, after understanding all of these immense challenges, you still feel that pull and want to learn the fundamentals, the YouTube channel How to Start Forex can be a good starting point. But please just remember, education is only the very first step on an incredibly difficult path. For more clear-eyed explainers just like this one, be sure to like, share, and subscribe.
All right, welcome to The Explainer. Today, we are tackling the big question, the one that probably brings a ton of people into trading in the first place. Can you really make big money starting with just $100?
You got to start with the dream, right? It's what gets people excited, and it usually looks a little something like this. A trading plan that promises to turn a tiny, tiny stake into a life-changing amount of money, and fast. And what's the magic number attached to that dream? $80,000. That's the target, the finish line. I mean, it's a number that's designed to make you stop and pay attention.
So how on earth is this supposed to work? Well, the whole strategy is built on hitting a consistent 25% gain every single week. And with the power of compounding, that $100 doubles in the first month, then it really starts to take off. And before you know it, boom, you're at that $80,000 goal.
I mean, that just sounds impossible, doesn't it? How can you possibly generate the kind of profits you need to fuel that crazy growth from such a small account? Well, this brings us to the single most powerful and, yeah, the most dangerous tool in a Forex trader's entire toolkit. That tool is called leverage. You can think of it like your broker giving you a temporary loan. It is the absolute key that lets a small account control a much, much bigger piece of the market.
So here's a simple breakdown of how it works. Let's say you get a common leverage ratio, something like 1 to 100. That means every single dollar you have in your account now controls $100 worth of currency. So all of a sudden, your humble little $100 account is commanding a $10,000 position.
And this right here, this is exactly why you'll always hear people call leverage a double-edged sword. It just magnifies everything. A tiny little market move in your favor can suddenly mean huge profits compared to your initial $100. But a small move against you can wipe you out just as fast.
On paper, it seems like the secret formula, right? But what happens when this perfect theory smacks right into the messy, unpredictable reality of actual trading?
Well, let's just listen to what actual traders have to say. Take this user, for example. They felt that incredible high of turning $100 into $1,000, only to watch it all disappear on a single bad trade because they got overconfident. It's such a classic story, a real cautionary tale. And this isn't a one-off. I mean, you go on the forums, and they're just filled with these reality checks. You see traders warning each other about the intense psychological pressure and about all the failures you don't see behind those flashy success stories. The truth is, for every big win, there are just countless blown accounts.
Look, these aren't just a few sad stories. They all point to one single, kind of sobering truth. And it's a truth that's backed up by some serious data. Check this out. A 4-year study from France's top financial regulator found that a staggering 89% of regular people trading these markets lose money. That's nearly 9 out of every 10 traders.
And we're not talking about small losses either. The average loss per person was over 10,000 euros. This isn't just about losing that first $100. For a lot of people, the losses can get way more significant over time.
And if you want to see the proof, here it is, plain as day. This chart shows a clear, undeniable link. As the leverage you use goes up, your probability of losing everything climbs right along with it, getting scarily close to 100%.
And it makes sense then when you read stuff like this. The fact is, for most traders, this journey is a very short one. The high-risk game means the majority of people don't even make it past their first year.
Okay, so if that whole $100,000 to $80,000 dream is basically a statistical fantasy, then what should a trader actually be aiming for? What's a realistic professional goal?
Well, if you ask the pros, the firms that actually fund traders with their own money, they'll tell you something very different. For them, a good, consistent, and achievable return is somewhere between 1% and 4% per month.
Now, I know what you're probably thinking. 2% on $100 is $2. Who cares? But this is where you have to shift your perspective. You have to stop thinking in dollars and start thinking in percentages. Consistently making a 2% monthly return is an incredible skill that most professionals would be absolutely thrilled with.
And here's why that percentage is so impressive. A steady 1% to 4% a month adds up to anywhere from 12% to 48% a year. That absolutely crushes the average annual return of major stock market indexes like the S&P 500, which historically gets you around 10%.
So the huge takeaway here is this. Successful trading isn't about hitting the jackpot. It's a game of survival. It's all about disciplined risk management and just grinding out small, consistent gains. This approach works because it keeps your risk on any single trade really low, which helps you handle the pressure and avoid those huge, catastrophic losses that knock so many people out of the game.
Ultimately, it all boils down to what you really want. Are you in this to chase that lottery ticket, that $80,000 dream that has an almost certain chance of failure? Or are you here to patiently build a difficult but sustainable skill?
If building that skill the right way is what you're after, I'd really recommend checking out the resources over at the How to Start Forex YouTube channel. They've got some great stuff on responsible trading. And hey, if you found this explainer helpful, be sure to like, share, and subscribe. Thanks for watching.
Hey everyone, and welcome. Today, we're diving into probably the #1 question new Forex traders have. You've got $100, what lot size can you actually trade with? Let's get you a solid, calculated answer so you can trade with confidence.
So you're sitting there with $100, ready to go. The real question is, how do you make sure that money is still there tomorrow? Because let's be honest, this is the hurdle that takes out so many new traders. The goal isn't just to place a trade, it's to survive and stay in the game. And it all comes down to getting your trade size right from the very start.
All right, here's how we're going to break it all down. We'll start with the huge confusion between leverage and lot size. Then we'll really get into what lot sizes are. We'll cover the golden 1% rule, and then, the best part, we'll actually calculate your perfect lot size step by step. And finally, we'll wrap up with your main takeaway.
Okay, first things first, we have to tackle the biggest, and I mean most expensive myth in Forex trading. People mix up leverage and lot size all the time. And trust me, that simple confusion is what really blows up accounts. It's not the tools themselves, it's how they're misunderstood.
Let's make this super clear. Think of it this way. Leverage is just the key your broker gives you to open the door to a trade. It reduces the cash you need up front. That's it. Lot size, on the other hand, that's how far you swing that door open. Are you peeking out just a little bit, or are you throwing it wide open to a potential storm? Your lot size is your risk, period.
So when you see something like 1 to 500 leverage, what does it really mean? All it means is that your broker is letting you control a larger position with a smaller amount of your own money set aside as margin. It's about capital efficiency. It lets you get in the game without needing, $100,000 just to place one trade.
And this is the point I really want you to get. Higher leverage does not automatically equal higher risk. It just doesn't. What creates risk is having no plan, no rules. If you manage your trades properly, it almost doesn't matter if your leverage is 1 to 30 or 1 to 1,000. The danger is never the tool, it's the trader using it without a plan.
Okay, so if leverage isn't the big scary monster, what is? Well,
That brings us to the thing that actually controls your risk on every single trade, your lot size. This is the number that decides how much you win or lose pip by pip. So in Forex, trades are measured in these standard amounts called lots. A standard lot is massive. Every little pip move is worth about 10 bucks, way too big for our $100 account. A mini lot is about $1 a pip, still pretty risky for us. Now we're getting to the good stuff. A micro lot is about 10 cents per pip, and a nano lot is just a penny. These are the sizes that give us the fine-tuned control we need.
And here's the bottom line for you. With $100 in your account, you are living in the world of micro and nano lots. That's it. This isn't just a friendly suggestion, it is the #1 rule for survival. It's how you make sure you get to trade again tomorrow.
All right, so now we know which type of lot sizes to use, but how do we figure out the exact size for any given trade? Well, that brings us to what is, without a doubt, the most important rule in all of trading. This is the one thing that separates the pros from the amateurs.
And the rule is beautifully simple. 1%. You never ever risk more than 1% of your account on a single trade. This is your financial shield. It's your armor. It's what keeps you in the game long enough to learn and become profitable.
Let's make that totally real for you. 1% of your $100 account is $1. That's your line in the sand. That's the absolute most you are allowed to lose on any one idea. If you stick to this, you could have 5, even 10 losing trades in a row and still be in the game. It gives you incredible staying power.
Okay, so we've got the rule. Risk $1 per trade. That's great, but how do we turn that into something we can actually type into our trading platform? Let's walk through the exact calculation right now.
Before we crunch the numbers, I just have to share this quote. It's an old trader saying that just hits the nail on the head. If your open trade is keeping you up at night, your position is too big. Simple as that. And the math we're about to do, it's designed to make sure you always sleep soundly.
Here are the 4 simple steps. Step 1, you know your risk, $1. Step 2, you need to know your stop loss in pips, which comes from your trading strategy. For this example, let's say it's 20 pips. Step 3, we need the pip value for the lot size we're using. For a micro lot, that's about 10 cents. And finally, step 4, we plug it all into a simple formula.
And here is that beautiful little formula that connects everything. Your lot size is your risk amount divided by your stop loss in pips multiplied by the pip value. This takes all the guesswork out of it. It's a precise calculation that turns your risk rule into an actual executable trade.
So let's run our numbers through it. We've got our $1 of risk, and we're dividing that by our 20 pip stop loss times the 10-cent pip value. That comes out to 0.5. So what does that mean? It means for this specific trade, you should open a position of 0.5 micro lots. In your trading platform, that might look like 0.005. That is your perfect calculated lot size.
So let's bring it all home and talk about the big picture here. When you're starting with a small account, the mission isn't to get rich overnight. The mission is to trade smart, to protect what you have, and to build the right habits that are going to serve you for your entire trading career.
So, if you forget everything else, please remember these key points. Your lot size is never a guess. It is always a calculation. Always risk a tiny percentage of your account, like 1 or 2% max. Remember, leverage is about margin. Your lot size is about risk. With $100, you're a micro or nano lot trader. And above all else, your #1 job, before making money, is protecting the money you have.
So there you have it. You now have the most important tool for survival in the Forex market. That's the first and most critical step. So the question becomes, now that you know how to protect your capital, how are you going to learn to actually grow it?
Hey, if this explainer finally made sense of lot sizes for you, do me a favor and hit that like button, and maybe share it with another new trader who could use it. And of course, make sure you subscribe to our YouTube channel, How to Start Forex, so you don't miss any more guides to help you trade smarter. Thanks for watching, and I'll see you in the next one.